This is Order Flow Trading Course Lesson 18, Integrating Order Flow with Traditional Technical Analysis. My name is Michael Valtos. I'm the founder of orderflows.com. First, a quick disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. CFTC Rules 4.41 state hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Okay, so lesson 18 is about integrating order flow with technical analysis. Order flow can be used as a standalone way to analyze the market, or you can use it to complement existing technical analysis that you currently use. There's the term confluence, which is when you have two or more indicators giving the same market indication. Many traders look for a confluence in the primary and secondary indicators. What that means is, say you have two or more ways of analyzing the market. When they're both going in the same direction, you have confluence. So watching how the market reacts to your support and resistance levels. Is price being rejected at those levels? Are traders being aggressive getting through those levels? So say you have a way of determining support and resistance levels in the market without using order flows. Order flows will help you refine your entries and exits around those support and resistance levels. By watching how the price is acting at those levels, you can see if price is being accepted or rejected, or if traders are being aggressive as you reach those levels, or if they're not being aggressive. If they're being aggressive, you may have extended follow through those levels. So it's important to see not just that price traded your level, it's important to see how price reacted when you get to your levels. So many veteran traders often view volume as a secondary indicator to help confirm other technical indicators on their chart. Now, when I say veteran traders, I mean, traders that have been trading, that have their way of trading for, many years, and sometimes, they don't necessarily look at volume, they have their own ways of analyzing the market. But if there's a big upside price breakout accompanied with heavy volume, the move is considered strong. It's interesting when, technical analysts don't look at volume, but then all of a sudden they see a big move and they see the volume is heavy. All of a sudden, oh, you got heavy volume. It's interesting how they use it to, after the fact rather than using it, during the normal course of trading. So a big upside move or a move to a new high that is accompanied by light volume give the impression that the move is weak or suspect. So, how can order flow help you? Order flow can help a trader gauge how aggressive traders are in the move. This is especially useful when a market starts to trend. So, when moves start, you have to take into account, how moves start. Everyone wants to get in on a move, but, the earlier you get in on the move, the better. So what you want to notice is as you start to move away from an area of, price acceptance, are traders being aggressive in the move? If they are, then the move is likely to continue. Are traders being aggressive in the opposite direction of a trend? If so, the move may be about to end. So what that means is, say you're rallying and you hit a high, go sideways, and you start to see sellers being aggressive on the sell side, then, the move up, is probably over. And, it's one thing if it's going to continue to go down or, just sort of hang around the high level. I mean, there may be, aggressive selling, but it may still be met with buying. As people see the prices have moved higher and they're trying to also get in thinking of a continuation. It's when the sellers are going to be overwhelming the buyers that the move should end and start in a new direction. So which indicators, forms of technical analysis work best when combined with order flow? Pretty much most forms. Support and resistance levels, pivot levels, Fibonacci levels, daily, weekly, monthly highs, lows, value areas and nodes, initial balance, trend lines. It doesn't really matter what you use. Sometimes I think you can just draw random lines on a chart in the markets. I'll say the market will react to them, but you'll see there's going to be times when the markets, seem to bounce off those levels, and it could be completely random. It's sort of the right to use that. It's not really a random walk theory, but it's one of those things you put 100 monkeys in a room and give them all typewriters, and eventually someone will write Hamlet. But you can have levels. It doesn't really matter how you come up with them. As long as you're convinced that your way of finding levels is the right way. Watch how price reacts around them. Watch the order flow and see what happens. So when the market gets to your levels, is buying drying up? Is selling drying up? Is the market trading in balance, or are you seeing a lot of market imbalances in the form of aggressive selling, aggressive buying? Is the market doing what it's supposed to do? Those are all questions you should be asking when you're looking at your form of technical analysis when it's mixed with order flow. Traditional lagging indicators such as moving averages, RSI, MACD do not really lend themselves well with order flow since they're based on too far in the past and not really levels as opposed to mathematical calculations based on price. What I mean is, you have a moving average, a 200-day moving average. Yeah, price can react around it, and price does, obviously, but what are you using to calculate it? It's a 200-day moving average. You're going back 200 days in your analysis. Do you really want to go back 200 time periods? If you're using a 1-minute chart, you could go back 200 minutes, but you're going back quite a bit to sort of figure out your calculation based in the present. That'd be like looking at a bar chart and sort of basing your analysis and your current price based on where you were 3 hours ago. Is it prudent? I don't know. I'm not a big fan of moving averages and RSI and MACD, but if you are, then more power to you. Try and mix order flow together with it. I think order flow is better. Watching how prices react around certain levels. If you're getting up to an area where you think the market's overbought or oversold, yeah, watch the order flow, see if buying or selling is drying up, and seeing if traders are being aggressive at those levels. Like I said, it doesn't really matter what other form of technical analysis you want to use with it. With order flow, what you want to do is you want to apply what you know about order flow in addition to your existing technical analysis. Now, one of the buzzwords in trading, besides order flow has become a buzzword in the last several years, but another one is VWAP, volume weighted average price. And, I see people use the term VWAP, and, that's the way institutions trade. However, the way that these people write about VWAP is they don't necessarily understand how it's used by institutional traders, and in turn, I think they have bastardized it into a glorified moving average. VWAP is used by institutional traders as a measurement of trade execution, not as a level to buy or sell around. No one has gotten rich by beating VWAP except the brokers. Institutional traders are only concerned with the VWAP during the time their order is in the market getting filled. They measure their trade execution price against the VWAP from the beginning of the execution until the time it is filled. VWAP is not without its limitations as well. So what that means is, a trader has an order, okay, a portfolio manager has an order, gives it to the execution trader to execute. He needs to buy 2,500 E-minis, and he'll say, execute it over the next 30 minutes. So the trader will execute it over the 30 minutes, and he'll have his average price. Now, what the portfolio manager will do to measure whether it's a good fill or a lousy fill is he'll take the VWAP from the time the order started executing to the time the order stopped executing. If his average price is below the VWAP, it's a good fill. If it's above the VWAP, the trader did a lousy job of filling it. What he expects from the trader to do is he expects him to participate at the price levels that's trading. He doesn't want him to take a view on the market and, sort of work it in when he feels like it. No, he wants to participate at those levels. He wants a weighted average, an average price based on the volume that's traded. So he wants to participate more when there's more trading and, less when there's less trading. So, when I see people, using VWAP in their trading and they got a VWAP running from the entire day and they think, oh, there's 2 standard deviations from VWAP. I sort of cringe at that because, VWAP, like I said, VWAP has its limitations. Certain times of the day inherently have more volume. When the market opens, it's going to be a lot of volume. When the cash session opens, it's going to be a lot of volume. Later in the day, the VWAP is going to get flatter. So if you have a move later in the day, it's going to have a smaller impact on VWAP. For example, the minis trade, the E-minis, will trade by 9 o'clock. You should have 500,000 contracts more or less traded. By 12 o'clock, all of a sudden you have, 1 million contracts traded. So, taking the VWAP from the Globex open until 9 o'clock, you have 500,000 traded. But then over the next 2 hours, 3 hours, you got another 500,000 traded. Well, by the time you're going into the last 2 hours of the day, you've already got, 70% of the volume traded. So your VWAP profile is going to get flatter. Also, depending on when you start your chart will have an effect on VWAP. I mean, do you want to take VWAP from, like I said, the beginning of the session at the Globex reopened in the evening? Or are you going to be taking it at 8:30 when it opens? Either way, it's going to have an effect on how your VWAP is calculated. That said, I'll say the majority, but nearly all of institutional traders, when they look at VWAP, they're only looking at VWAP for that particular time the order's in the market. Like I said, they use it as a measure of execution. They don't use it as a way to trade around. I mean, some people probably do now, that it's so much, word around it, so much talk about it. But, the algos that trade around VWAP, they're a completely different style of trading than you and I, as retail traders. So, I mean, probably earlier in the day, VWAP is going to fluctuate more than it is going to later in the day. If you've traded already 1.5 million contracts, it's not going to have much effect on the next, 200,000 contracts as you're going into the close. So, it just pains me to see, people that have never worked on the institutional side start talking about VWAP when they don't necessarily understand how it's used on the institutional side. They see it as an indicator and they think, oh yeah, hey, I could use that, but they're using it in a way that's not being used by the institutional traders. And like I said, they just sort of turned it into into a form of a moving average. And then they start talking about when you move 1 or 2 standard deviations from it, that price should go back to it. Well, that doesn't necessarily always work that way. So, anyway, enough about, my problem with the way people use VWAP. Let's take a look at other forms of technical analysis and order flows. So this is a Fibonacci chart. Well, this is the order flows chart with Fibonacci retracements laid into it. I like to use 50% as a pullback. Others, 38% or 61%. But what do you have? As you get up to the 50% area, you're starting to see some small prints. So, it's a sign that buying has dried up on this pullback in there and, look for the move to come back down. Even at the 38%, you're seeing a selling imbalance up here, which is also, a sign that the market should sell off. Again, this is E-mini chart. This is a 5 range, and it's also Fibonacci retracements. You have your high up here, you have your low down here, and drawing the. This is a standard one on NinjaTrader. You could just couple clicks. Most software has it. You don't need anything fancy to use it. It came right back up to 50%, started coming down, and then you can see here at the 38%, you have a single print in a ratio, and the market sold off some more. So I'm not a big fan of 61%. Usually I prefer 50%, but sometimes it's quite close. It's not much of a difference between 50 to 61. It might be a point or something, or a few ticks. I mean, depending on how what sort of where your highs and lows are that you're using for it. I try to get something where it's a decent move. Probably 6, 7, 8 and above points. Before I start getting interested in drawing any sort of retracements intraday. This one is basically around a 5-point move, and it's a 5-range chart. So from your high to your low, you come back up to just about right at the 50% level. Again, you get a single print, and the market sells off. Basically another 5 points. This is a trend line for those that like to draw trend lines. The trend lines are a bit subjective. They're not something that is necessarily easy for people to draw. People, you could give a chart to 10 people, you probably get 9 different trend lines drawn. Well, I'll say 9, probably about 7. It's hard. I have my way of drawing trend lines. I don't necessarily like to just cover it down. I like to go from a high to a high. I don't necessarily need to have so many points in a trend line. If it's a wide enough area, so go from this high to this high, you come off, that's going to be my point in the trend line. Some people try to draw it a little bit steeper coming down here. The steeper you go, sometimes the more violations of the trend line you're going to have. I don't want to get into a dissertation on drawing trend lines, but watch what happens as you come off a trend line and you start to go through it. Is there, towards the bottom, before you start coming back up to the trend line, is there, any sort of ratios in there, anything to get you interested in, buying the breakout? So, I see here, I see a ratio. Get to the other side, it's met with some ratios. Then, it starts to come down again, and you got some ratio stopping it. So it's for me, this is a valid trend line break. Okay, well, this is a chart's a little order, but this is a Fibonacci again, and from this high down to this low, we've come back up just past the 50% line. First time you have a ratio, but then you sort of pop up and you get to the 61% line. Then you come back down, and at the 50% line, you get the small single print again, which is it's telling you that it looks like now the buying has dried up and the market is starting to react to go lower. Okay, this next chart is Bollinger Bands. And, when you're trading Bollinger Bands, you want to see when you come up to the upper band and what's going to happen, or the lower band. And you come up here and you're seeing a ratio, you're seeing stopping volume, and we trade right back into the middle band and onto the lower band. Again, we trade from the lower band up to the higher band, and this time you have a ratio. It's the thing with bands, or you're trading in sort of, you say you have these bands. You want to see how when you touch the bands, if there's any sign. It's going to be lots of times there's no sign. Like here, you don't have any signal with any ratio that you like. But you rallied up to the next band, but you do have a ratio, and the market reacted. Because there's going to be times when you're trading inside of bands where you're touching. This is the previous chart. You hit the upper band, but nothing. You sell, you hit the upper band, nothing. You sell, you hit the upper band. Now you have a ratio, and the market comes off. This one is again, it's a Bollinger Band. I'm not the type that likes to trade around the center line. When you get, because you could be on the other side, both sides of a center line in a bar, and it's hard. But what's happened is you've come down into this lower band here, and between the center band and the lower band you have a selling imbalance. And then you don't have anything. You touch the lower band here, but you don't have any clue to really get long. You do have a divergence, but I mean, you can't just get long on every divergence. And you rally back up into the selling imbalance, and then you start coming back off. You hit the lower band again with the single print in the bar with the single print, and the market goes lower. It's there's all sorts of examples. I could give you examples all day long, but I'm just giving you a few. Here you have, again, it's a Bollinger Band. You hit the lower band, you have a ratio, and you have a selling imbalance at the low, and you trade right up to the middle band on up to the top band, where it sort of stops up there based, you have another ratio. So, what you want to see is, if you're picking your levels, say you have a way of trading in technical analysis that's giving you some sort of levels, try and look at order flow with it and how the price is reacting during, around your levels. I'm not a person that, is looking to get in on every single move. I'm just looking for the times where order flow confirms what I think should happen. I said if you're trading, say Bollinger Bands, right, you're not always selling whenever you hit the high band and buying whenever you hit the low band. You want to buy, at the low band when you have a reason to buy. You want to sell at the high band when you have a reason to sell. You don't want to just keep selling because, you go from 1 standard deviation to 2 standard deviations to 3 standard deviations. And then you're broke after you hit the 4th standard deviation because you kept selling it. It was looking for the reversion back to the mean, and it never happened. Okay, this is a 200-day moving average, this green line. And I said I'm not a big fan of moving averages because, sometimes the market will go and just sort of trade around it. But then, what happens as you're trading around it, but then you see the buyers come in. You see, just on the other side of the 200-day moving average, which is, a long-term moving average. So is it important? Yeah, probably more important than, say, a 40-day moving average, just because it's taken a lot more things into account. But still, you want to see how price reacts around it. There's no price rejection here, and what you have is you trade up from below it, up through it, and then all of a sudden you're seeing more aggressive buying come in just on the other side of it to continue it in that direction. Okay, so this is, again, the 200-day moving average, and what are you seeing? You're starting to move towards it, and you're really seeing all the single prints line up, and you break through it, on a single print, and, just all around it you have selling imbalances. So, yeah, it's telling me the market is more than likely to break through that, level. So this is the continuation of this chart is A, this chart I'll take as B, because this is just the next few minutes. And what happens? It does come right down through it, rallies back up towards it, and continues down lower. So it wasn't like the strongest move, but you're seeing here early signs that as you're going to be making the run towards that average, that there's some aggressive selling coming in, and there's price rejection up here in the form of these single prints. So, I think it's a high probability trade that you're going to get past this level, and, instead of this level acting as support, once you get past it, it'll be a resistance level, which is exactly what happened. So, even if you're not yet convinced that this is, a true breakdown, you throw an offer up around the average and, look for a pullback in there, and a continuation lower. So I mean, you could have got at least a few points out of it in a very quick manner. So this one ends at 8:39. What day is that? The 20th. So this is about 10 minutes later. So we come back up, go through it, and we're just sort of hanging around it, and you're not seeing anything, necessarily, as you're hanging around it. It's when you get to this area, you're seeing the price rejection again in the form of the small print. You don't necessarily have it here, or here. I said you're seeing some buying imbalances, but it's met with selling imbalances. you're thinking here maybe that, you got this big buying imbalance, 1,000 just on the other side of the average, but it could only get up 2 or 3 points, and now you're seeing a single print with the ratio, basically indicating that there's really not much interest up here above this, this 45.5, 46 and above level. Then what happens? Again, the market sells off. So, that's one of the problems with trading with moving averages is they often price sort of will, it acts as a magnet, and then once it's around there, it just really can go sideways on you sometimes, and you're going to get chopped up. Said I'm not a big fan of moving averages, but you can do some analysis of order flows around them. So here's a trend line again, and it's drawn from the low and here. So you got your couple points, 1, 2. Up here, you're well above the trend line. You have the high. Okay, you're looking for a break. You get the little breakthrough here. Maybe you're not that. You don't want to just sell the trend line breakout. You want to have a reason to be short once you break the trend line. And here's your reason. You got the selling imbalance. You're seeing these ratios here to hide behind. If you're getting short in this area, you get a nice little move lower. Okay, this one is a little bit more, I'll say esoteric, but it's a GAN fan. You could Google GAN fans and try to understand them. But for me, it's the way I view it is sort of a fancy trend lines. It's like an array of trend lines. But what I've always found important with the GAN fans is the 45-degree line, which is this one in the middle, the 1x1 line. To me, that's the most important. A lot of people will look at this 2x1 or this 4x1. Price will hold the 4x1. The one that fails, it'll hold the 2x1. The one that fails, it'll hold the 1x1. But for me, the most important one is I've always found, and I did do a study into GAN stuff earlier in my career back in the 90s. For me, I've sort of carried the 1x1 line over to my normal trading. It's a level I'm always looking at. Basically, it's the 45-degree angle line. And, I'm always interested if we're going to break that, for the breakdown to occur. And here I see, at the 45-degree line, the single print bar, with the ratio that I like. So, to me, it's indicating that if we could break this level, this 45-degree line, we should stay below it and go lower. But for me now, the 45-degree line, I don't necessarily draw the angles on the chart. It's more of a visual thing. Now, this is the Andrews pitchfork, and it's an interesting tool. It's an old-timers, I'll say old-timers tool, but it's a tool used by people that have sort of been around the markets for a long time. You sort of see it rehashed nowadays, but it was a lot of people that trade ags followed it back 20, 30 years ago, but it's still followed today, and it's an interesting little technical analysis piece. Basically you have a channel here, and you're looking for the breakout again of the pitchfork. It's shaped like a pitchfork. So here, you're inside this, inside this lower channel. So you're going to be looking for a breakout, and what's this first sign is, okay, maybe we could be close to a breakout. You have this selling imbalance. So if you could break out through there, where's it go? It sells off nicely down to, basically a 4 or 5 point sell off. It's an indicator that comes with most trading software. I said I use NinjaTrader, and it's on there. Just you right click on your chart and you can pull it up. Again, this is more on a longer term chart, and what you want to see is when you're touching these areas, the channels, how price is reacting. here you get on the other side of it, but you got a ratio which is bullish. You trade right back into it, so maybe you didn't catch that move, because it's a little bit on the outside. I don't necessarily know if I would have been getting short there. If I was, when I see this ratio, I'd be looking to get long again. We're trading up to the middle. I'm not a fan of trading in the middles. Then we start touching it again here. This is around the 46 level. And you see in ratios, it just trades right back up into it again. So it's, when you're touching the bottom of a channel, watch what price is doing. Okay, now this is on a bonds. This is, as the market went down, you got your pitchfork here. You're trading at the upper end of the channel, and you start to break out. And what happens right when you break out? You broke out here, but you traded back inside. But now it's giving you a sign that it wants to break out again, and you have a ratio. You got a small print forming there, and the market did break out of it, but it went mostly sideways. I mean, that's a light win. It's a couple ticks is a couple ticks. I said not every winner is going to be something you could go on vacation with, but you add enough of them together, then that's great. So these are just a few of the great ways you can integrate order flow with traditional technical analysis. Personally, I'm not one to use many indicators on my charts due to the cluttered feeling it gives me, and I prefer to keep it simple. However, I know there are traders killing it out there that because they use order flow in their own technical analysis and are kept out of a lot of bad trades. Like I said, say you have your own support and resistance lines, but you notice half the time they work, half the time they don't work. What you want to do is you want to refine it and get more of the times that they do work and less of the times they don't work. I do think order flows can help you in that regards. I have customers that came to me, they wanted to learn order flow specifically because they know how price reacts around their levels, but sometimes it works, sometimes it doesn't work, and they wanted to refine their entry levels, or learn to stay in a trade maybe a little bit longer when the trade is right based on their analysis. So they'll use it in two ways. One, they'll use it to refine their entries, and two, they'll use it to try and get a little bit more out of the trade. Like I said, if you could add an extra tick, to every trade at the end of a day, that could add up at the end of a week, at the end of a month, at the end of the year, it could be a lot of money. You shouldn't sneeze at one tick. So, I said just making one extra tick, imagine what sort of difference that can make in your trading. So that's the end of lesson number 18, integrating order flows with traditional technical analysis. In the next lesson, I'll let you apply all you've learned via a series of charts in different markets on different days, so you can see the thinking process as the day unfolds. This next lesson, lesson 19, is going to be a long one, just because I'm going to show you charts on a intraday basis and sort of let you digest it, then I'll discuss it. So thank you. That's the end of lesson 18.